MongoDB, ticker symbol MDB, reported earnings after the bell, and it was absolutely ripping to the upside right here. It held these gains, and that was after being up 3% on the day. So we are going to talk about MongoDB, why the earnings was so good, and if it is a buy right now. But before we continue, if you could please go ahead, like and subscribe. It really helps me out. Let's quickly do an overview of what MongoDB does, because I don't think many people actually know. So we're just going to read this here from AI Overviews. MongoDB is an NoSQL document database that stores data in flexible JSON-like documents rather than in tables and rows like traditional relational databases. This allows it to handle structured, semi-structured, and unstructured data efficiently, making it popular for building web applications, mobile apps, and other applications where data is not always rigidly defined. MongoDB offers features like horizontal scaling, replication, and sharding to ensure high availability and in performance. So essentially, it's just a document database to build highly available and scalable internet applications, especially if you need to access that data very rapidly. Now, the TAM actually pretty big. According to MongoDB, this is where we are right now in 2025, and the TAM is looking to increase by about 50% through 2028. So there's definitely tailwinds, and this is actually one of the things I look for in a business. I really look for an expanding TAM, because it sort of just means if the company could just chug along, if the TAM is going to expand at 10, 12, 15%, that's really going to be their baseline growth rate, assuming they don't take or lose any market share. And MongoDB are actually a very small player in the grand scheme of things. MongoDB only have a 2.4% market share in Fortune 100 companies, and in Fortune 500 companies, they have a 2.1% market share. So they definitely have room to go ahead and take market share. And that's exactly what MongoDB did this quarter. They grew their earnings. They grew their revenue 22%. Their earnings per share grew 96%. It was a beat on both sides. And look at the analyst estimates. Now, this is non-GAAP. The analyst estimate was for 66 cents. They came in at $1. Absolutely crazy operating leverage, and we'll dive deeper into it. But the reason why I think the stock was actually up had to do with, I think, their margin profile. Now, if we actually exclude net income margins, right, because there's a whole bunch of depreciation, amortization, write-offs, one-time charges that impacted this figure right here. If you look at the free cash flow margin, the company is turning profitable in a very big way, literally growing from a 1% margin to very close to a 20% free cash flow margin, by the way, guys. Very good. You could see essentially the nominal dollar went from 2.1 million to about 108 million in Q1 2025 compared to the same quarter last year. Net income was a little bit rough just due to some expenditures that they incurred in this quarter. Their gross margins did decrease ever so slightly, but that comes with a company that's growing and rapidly trying to take market share. And their balance sheet, very solid. They're sitting on about $2.5 billion of cash, virtually no debt. This is the type of business I actually love. They have a big cash pile. They're growing, turning profitable, virtually no debt. You love to see it. Now, the company has just been an absolute revenue machine, 5xing revenue from January 2020, about 124 million in this quarter right here. They did about 549 million in the most recent quarter. So absolutely insane. Absolutely crazy. I mean, this CAGR, right, is 32% over the last 5 years. It's just absolutely ridiculous stuff to see a company like this. And we looked at CrowdStrike yesterday. That was another business that had grown 8x since 2020. So there's definitely high growth, very high quality companies and opportunities out there in the market. Now, looking at some of the earnings highlights, so we spoke about revenue growing 22%. Now, MongoDB has this revenue segment called Atlas. It's their high growth segment. That made up 72% of Q1 revenue. That grew 26%. They also authorized $800 million worth of share repurchases, bringing the total buyback authorization to $1 billion. I don't really like this for a company that has negative net income and they're not really making this in free cash flow. They're buying back stock, but I think that's just to offset dilution because this company is diluting shareholders significantly. And then they added 2,600 new customers in the quarter with over 57,000 total customers as of April 30, 2025. Now, this is customer count metrics. You can see 57,000 customers. Their Mongo Atlas customers was 55,000. Their direct sales customers was 7,500. And then customers over 100K per year in terms of billings, 2,500. So these are the high value customers right here. And look, these metrics continue to grow. So the business isn't just increasing pricing, right? They're actually growing volume as a whole, going from, look at 2023, 43,000 total customers to 57,000. That's like a 40% increase in that time period. Now, let's look at the financials in a more granular fashion. So revenues grew 22%. Cost of revenues were up 29%. And that is actually why you saw gross margins a decline. And that's just simply, the cost of doing business, especially as it pertains to, where the inflation picture is, tariffs, and simply just a higher overall resource mix. Operating expenses, however, only grew 4.2%, and that is how you had that massive non-GAAP EPS beat. However, operating expenses as a nominal figure is still really high, and that is why the company actually had a net loss of 37 million. That is actually down from the 80 million figure in the previous quarter. So we are seeing a trend in the right direction. On a non-GAAP basis, the company was actually profitable, but I much prefer to look at GAAP income. Now, looking at the guidance figure for the second quarter and the full year, the company's looking at about 17% growth here for the second quarter, about 19% growth for the full year, looking at 548 to 553, and then, sort of in the $2.2 billion range for the full year. Operating income as per follows, and then net income in terms of earnings per share, looking at about 62 to 66 cents, and then anywhere from $2.94 to $3.12 for the full year in earnings per share. So where does this leave us with overall valuation? Now, company in certain metrics isn't profitable, so we're going to look at something different. We're going to look at the free cash flow yield, as you can see right here. So it's 0.78%. The business doesn't look attractive on a free cash flow yield standpoint, but do take into consideration that the company is only just turning profitable. It has had profitable quarters, but turning profitable at scale with 19% free cash flow margins, it's only just happening. So this should expand in a very big way over the next year, assuming they can hold those 20% free cash flow quarter going forward. The company trades at nearly a 6 times EV sales and a negative shareholding yield, even with the buybacks that are currently happening. So look, the company is expensive when you look at it on these metrics, but when you project 5 years ahead, the company does have levers they could pull to sort of get great returns, but it will depend on execution. So the business did $2.1 billion in revenue in the last trailing 12 months, assuming that grows to $4 billion in 2029 on 27% free cash flow margin. So we're looking for like pretty robust margin expansion. They're currently at 20%, as you can see right here. So, margins are going to have to expand by 700 basis points. But if they can do that, you're looking at $1 billion in free cash flow in 2029. And if we apply a 30x EV to free cash flow multiple, we get the enterprise value, subtract the net debt, and divide by shares outstanding. Now, shares outstanding are going to increase every single year by 5%. That's probably a bit much, but, I'd rather be conservative than underprice, shares outstanding. But I think, 2 or 1% could be perfectly fine. I think, by end of 2025, 2026, shareholders shouldn't be diluted as much. And that leaves us with a 2029 stock price of $337. The current stock price is $227 as of the most recent close. And that would mean a 8.2% compounded annual growth rate. And if you discount that back at 12% of the fair value for the stock is $191. So look, the company is going to have to grow at the market consensus of 14% and rapidly expand their margins. If they can do that at a 30 multiple, the stock does look like a buy, although the S&P 500 looking more attractive. If they can have upside to these numbers right here, as well as their margins, certainly they could see upside to this figure right here. But look, it's really hard to say where this business is going to end up with their margins, especially with their business model, right? It's scalable, it's cloud native. You could potentially see 40% margins for something like this, right? It's very, very possible, as even in 2029. So using these figures, does MongoDB look like a buy? Probably not. But if it was below the 190 area, yes, it probably does look like a buy. On a technical basis, look, this does look like the place where you probably want to go ahead and buy. It's sort of at that 170 range, but the stock is now actually at $220 a share after the gap up. It's flirting with this 200-day. If it breaks this 200-day moving average, we can definitely see upside for the name, potentially targeting highs as high as 300, maybe even 400, assuming the rally just rips it to the upside. That is very, very possible. If we do get to this 150 region, I think MongoDB is a very strong buy and a strong contender for a long-term compounder. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.